Okay, good. All right, so welcome everyone. We are in week 2, and I'm really looking forward to your presentation today. I saw both groups' presentation. They look great. I can't wait to hear what you have to say today. And while you are doing the presentation, and let me explain, a lot of you have questions regarding about this page. This is your questions for the other group. So all I was looking for, I wasn't looking for answer, I was looking for questions. So let's say Chris's groups goes on presenting their materials. The other group's questions should be here already, so their group can answer the questions accordingly. So I'm asking for questions that your group of the opposite group. Hopefully that makes sense. But we'll come back to your questions as soon as we finish the presentation. I think that for the most part, this top one is good. That's what I was looking for in terms of questions. There's certainly a lot of questions, not just 3. And then group 2, I think the questions for group 2, I don't think this is the right chapter, to be honest. This may not be the right chapter. So whoever's wrote for the group 2, you may need to come up with some questions as group 2 is presenting, okay? All right, so this, I am going to stop sharing my screen, and you should be able to go ahead and share your screen. So whoever wants to go first, you could go ahead and take control of the screen. And while you do that, I'm going to make sure I have notes.
Yeah.
Who wants to go first?
I'm going to go first. I guess since we're all in for group 1, can someone work on, if I'll be doing the presentation, can someone work on the questions while I'm presenting from our group?
Yeah, we can do that.
Okay.
Yeah, I've got
Sounds
question too, no problem.
Okay, great, thank you.
Perfect. And then how do I take control of the screen?
In the bottom of the screen, you should have share screen. Just click on share screen. There we go. And remember, I'm not timing you, but I wanted to make sure we keep it within 20 to 30 minutes time frame. And as you present, I probably will jump in and have questions or have comments, okay?
Okay. And can everybody see my the slides?
Yes, I can.
Okay, perfect. Well, hello everybody, and we'll get started here. So today our group, which consists of myself, Ari Palmer, Eric Chen, Jeffrey Reagan, Jordan Iyer, and James Rossi, we'll be presenting on Chapter 2 of the textbook, Private Capital Markets, Valuation, Capitalization, and Transfer of Private Business Interests. The subject matter will be middle market finance, where we will discuss subtopics such as the evolution of middle market finance theory, value world theory, private capital, business transfers, owner motives, authority, and triangulation. Okay. So first, we like to cover the evolution of middle market finance, specifically in the realm of private entity valuation. Starting around the early 1980s, the business of private entity valuation started becoming a much more structured profession with agreed upon rules and values. Many argue that Dr. Shannon Pratt's book titled Valuing a Business, The Analysis and Appraisal of Closely Held Companies was a huge development for the business valuation profession, as it provided a very clear, structured, and professional take on the complex art of valuing a privately held entity. Since then, the profession has grown exponentially, and now it employs thousands of appraisers across the United States. Starting at around the early 1990s, the private capital market started to become much more complex and sophisticated in nature. As compared to prior to the early 90s, when a business's primary source of capital was getting a commercial loan from a commercial lender, post early 90s, businesses started leveraging strategies such as ESOPs, which we're familiar with as financial planners, family limited partnerships, and lease purchase agreements as examples to transfer business interests. Robert Slee, the author of the textbook that we're reading, he was quoted saying, "Owners often view transferring a business interest like grabbing the brass ring on a merry-go-round, but they need more help improving their chances." And this is true. Unfortunately, due to the sophisticated nature of the private capital markets, many professional advisors are not adept at consulting on the many intricacies of the field, such as choosing the right capital structure and the right capital strategy. Therefore, there's a need for more qualified advisors in the field of private entity valuation and middle market finance.
Can you go back?
Yes.
Okay, let me just add one thing real quick. In terms of your, what you're saying here, this quote right there, the owners view transfer a business interest, that quote that you have there, just two things that I wanted to point out.
Sure.
Yeah, not specifically to you, for everyone, is that keep in mind that for the purpose of financial planning perspective, the reason that we're going through these is that your clients would have need for you to help them. You are not in a position to do appraisal, but you are certainly in a position to help your clients understand how to increase the equity value. As a matter of fact, a lot of the transfer that we're seeing within this textbook, now you have to keep in mind, any authors or any researchers writing books and research and all that, they all have bias, including me, including each one of us here. Rob Slee, who is my mentor, he is one of the handful of the top 100 deal maker, if you will, in the country. Before the Shark Tank show, he was one of the person who was going to do that show. So just to give you some landscape of how many business that he's dealing with. Now he specialized in what we call the third-party transfer, and we're going to get through the transfer channel in the later chapters. So a lot of these things that you're reading, yes, is true from a third-party transfer perspective. So I wanted to kind of keep everyone in mind as you read through the materials, because he's coming in from third-party transfer. He doesn't do any internal transfer. So keep that in mind as you read through it. His view is based upon someone is going to make a transfer to sell. And a lot of time, the history of the business transfer has been transformed over time very differently now. In the past, it has always been viewed as a one-time event, meaning that just like what he's quote right there, that you wanted to get it right at some point, it is no longer today being viewed as a one-time event. If you do that, you actually are in a very fatal position helping your clients. It is not a one-time event. It is you have to take them through a process. So, and not every business owner wants to sell to third party. So just a little bit caveat before we go through a whole bunch of materials coming in from Slee's textbook. As a caveat, make sure that you know not everyone wants to transfer third party, and on top of it, it is not a one-time event. Okay, great, thank you.
Yep, absolutely. Okay, so everyone can hear me. All right, so the next slide brings us to middle market finance theory, and more specifically triadic logic, which you can see a picture of on the right-hand part of the screen here. So what is middle market finance theory all about? It's pretty broad field, but narrow it down, it's a theory pertaining to the integration of valuation, capitalization, and transfer of middle market entities, which typically comprise of companies with revenues that range from a minimum of 3 million to a maximum of 350 million. That's the general consensus on that. So here's an overview of the theory. Valuation forms the foundation of the triangle, and it determines the worth of the entity. However, valuation is dependent on the transfer category of the triangle to define value. What this ultimately means is that the valuation of an entity cannot occur without knowing what someone will pay for the business interest, which is pretty reasonable, which is further defined by market demand and the respective industry. The capital structure on the left-hand side of the triangle is dependent on valuation, as private capital flows to entities in accordance with risk and return principles. This all boils down to capital will be provided in exchange for business entities in accordance with the payer's required rate of return, much like investing in publicly traded entities. This also means that valuation is dependent on the value world in which it is viewed, which is a topic that I'll cover more shortly. Lastly, the transfer category relies on capitalization, as business ownership cannot exchange hands without money, capital to finance the exchange.
All right, before you go on to the next page, can we go back? I just wanted
Yes.
to, I know everyone know this, but I do wanted to make sure that everyone understand that from the middle market finance theory's perspective, this part right here, can anyone tell me what is capital? What is capital?
Company's ability to get access to capital,
Oh, so what is capital?
financing
Money.
to acquire your supplies that you need to make your product.
Okay, so right there, that we need to make sure that we understand what capital actually means before we have a good understanding what he's talking about. So capital has, generally speaking, has three parts. You have your debt portion, you have your preferred stock, and then you have your common stock. Okay, so this is important because later on in the book, or later on, I think you have a slide shows that we are looking for something called the return from these capital. Each one of the category that we see on the screen here has a different required return. For example, if you were to look at angel investors, and which is one of the categories that later on we're going to go through, that angel investors will require different type of return. If you look at your typical public traded company stocks, you certainly have a different required return coming back to it as well. So depending upon type of the capital, so from a transaction perspective, sometimes third-party sales could potentially structure in any of these. In the 80s, where Warren Buffett pretty much dominate this entire middle market, he will go out and he will look at companies worthwhile buying. So back those days, the debt leverage buying is very popular back those days. Now you have to be very, very skillful to make the return work for you. Today, not so much. So understanding what's in the capital makes a whole lot of difference in terms of when you're speaking to business owner, of helping them understand what are we talking about here. And for the most part, for the most private business, there's probably not going to be any preferred stock. For the most privately held business, they're probably just a debt and a common stock. And so as a combination of those two is going to determine what is the required return from the owners ourselves. Okay, so that's a whole different topic that we'll get into. The other things that later on in the chapters that we're gonna actually look at is that you have this valuation depending upon what type of purpose of the valuation changes. So that comes probably later, either this week or next week. You're gonna see that there are a variety of different value that we use in terms of helping owners. So keep that in mind. Different capital has a different return, different valuation has a different dollar amount, and different type of transfer. So there are different channels that you transfer out. All of that is going to factor in when it comes to transfer time. So that's why I was mentioning that in the old days, transfer has been viewed as a one-time event, is not so much anymore. So keep that in the back of your head as we go through the material. Okay, thank you, Ali.
Welcome. And we'll actually briefly cover the value world theory here on the next slide as well. And I know you were just speaking about that.
Okay, very good. Thank you.
Perfect timing for us. Let's see. Okay, so start with a quote here by Robert Slee, and that is, a private business value is relative to the value world in which it is viewed. So what does this all mean? So value world theory, I think it's a pretty interesting topic. It's very crucial to middle market finance theory. So here is a brief run through, and in later weeks, we go into it more from what I understand, but this is just a brief overview of it. So for private entities, the luxury of an active trading market does not exist. So therefore, just like on the triadic theory we saw, it all depends on what someone's willing to pay for it, how they can finance it, how it can be transferred. That all comes into the way the business ownership transfers. Robert T. Slee breaks down this theory within a few sentences. So what he says is for either a valuation to occur, the value of the private security has to be valued for some purpose at some point in time. The word purpose has a special meaning in this theory. Here it means the intention of the involved party for the reason of the valuation. Slee notes that purpose leads to the function of the appraisal, and that function is defined as the intended use of an appraisal. So based on this Slee concludes that for any one entity has a range of values at any one given point in time, and a private business value is relative to the value world in which it is viewed. So what does this all mean? Pretty much what it all comes down to is value is in the eye of the beholder. Some examples of differing value that we might all be familiar with include fair market value, which is used for tax purposes, insurable value for insurance purposes, and collateral value for lending purposes. But there are many other value worlds in which an entity or an asset might be viewed, and depending on the value world, the value changes.
Okay, so that's a pause for a moment here. Now there are several things that everyone needs to know in terms of what do we mean by range of values, right? If you get an appraisal of if your client give you an appraisal report, you need to know that bare minimum in that report, there's always 3 values, okay? And each one of those values are going to come in ranges. And the reason they will give you 3 values is that it will tell you that what is the closest possible value to your current industry, to your size of the firm, to your geographical location, so on and so forth. And the other 2, chances are could be used depending on what type of purposes that you are intended to use it for. And in that valuation report, that ranges also, one of the ranges will be used, and that will be something that later on in the chapters that we will see that if something were to happen in a business, one of these values will be used to quickly determine the value at the time of certain event. So keep in mind that as you see the valuation coming through, even if you're reading an actual report coming through, you do expect to see 3 different type of values, and each one of them has a given range. And the appraiser's role is to justify how they come up with these ranges. Okay. All right. Thank you.
Thank you. And actually, next I'll turn it over to Eric.
Perfect. Thank you, Ari. And, you know, I think we actually alluded to a lot of this earlier. Ari did, as well as you, Professor Jin. But again, going back to what Ari was discussing and the triadic model, basically we would need to understand, you know, a lot of valuation comes from capital. So capitalization, what is it? How is it defined? So again, it's basically the capital structure formation for a private business, or for any business really. And it's basically just asked like, how is money raised? How do you get funding for your business or your company to basically do what it does best, which is just operate? And so, like the professor said, it is, you know, oftentimes a mixture of debt and equity financing. It could be preferred stock, it could be common equity or common stock, it could be debt. And most of the times, you know, I know we're all very familiar with Shark Tank, and most of the times we hear about, you know, venture capitalists and angel investors, but those are just some of the more popular methods of sometimes raising capital for some of these middle market private entities. So again, it could be some examples listed there: common equity to VC firms. It could be industrial revenue bonds. It could be mezzanine capital. These were just some of the examples that were referenced in the reading. And as I think Ari alluded to, this fact as well is that, it's not like a public stock. It's not like Apple or Amazon or another company that's traded on the NYSE or on the NASDAQ, where, again, it might be easier to obtain capital. Private financing is more difficult. It's usually not as efficient because it is very individualized. It's on a case-by-case basis. Every one of these private businesses is going to be different from one another. And so, as a private entity, you might get funding from one source, a couple of years ago, and you might not even be able to rely on that same source consistently to raise capital. So again, the funding sources a past funding source doesn't necessarily make it a reliable source in the future. And as you see there, the quote at the top basically says that private markets can be thought of more as a outdoor bazaar rather than a public supermarket where you can just, again, pick what you want. More so it's individualized, very customized shops that you're going to, where everything is very unique. So everything has to be, again, kind of evaluated, examined on a case-by-case basis. And it is, again, a lot more individualized and more specific or specialized in this way. And if we actually go to the next slide.
Can we just stop here for a moment before we go to the next slide? So one thing I do wanted to point out is that part of the reason the private equity is very, very difficult, or private capital, if you will, very difficult to raise. This particular pandemic probably opens lots of problems that we don't typically see. For example, just for the payroll protection program, that loan itself, you've seen that and you've heard that in the news, where a lot of the privately held small business, which means 500 or less employees company, did not get it the first time around. And the primary reason is because they don't bank traditionally in those commercial bank. And so does the private capital here. Private capital isn't something that is really accessible. And because of that, there's inherent risks for the investor on the investor side. So on the flip side is that investors that tend to require very high return coming back, which means that privately held businesses, whether or not they are going through transaction, one transaction, two transactions, three transactions, each time when the transaction goes through, there's an inherent cost associated with that. And those costs of capital oftentimes are not being discussed with the owners, and so may or may not be worthwhile sometimes for the owner to pursue. So keep that in mind. Private capital is not just a nicey fancy term, it's real. This is the mainstream borrowing. This is the mainstream capital. It is quite difficult to get the right match, if you will. Eric mentioned about Apple's and Amazon. As a matter of fact, Apple, when they first started, before they become a public traded company, the very first go around, Steve Jobs was interviewed by 102 private capital investors, 102, and one of them took the chance to invest in that company for only $250,000. And at the time of that private capital investment, the investor required the company to have a CEO, not Steve Jobs, somebody else. So you can imagine that private capital, not only they're willing to give you the money to do business, but they also want to have control in the management. So it's not just the money. So keep that in mind as we go through the materials. Okay, thank you.
Thank you. And actually this slide does kind of transition pretty well off of what Professor Chen also was mentioning, is that basically for each major private capital type, and again, this was a study that was done by Pepperdine. Basically, there were certain benchmarks that needed to hit, which they called credit boxes to basically qualify. So, imagine again, you are like a private investor, just like the Apple example you just used, where someone is examining all the ins and outs of the business, not from just a monetary perspective, but even a governance perspective or anything else, where you're just examining how is the business going to operate? It's kind of like underwriting somebody for maybe insurance or a mortgage. You know, you want to make sure that they have the right qualifications and a solid business plan, that there is some promise in the future to show some return. So the study basically takes the various capital types and segments it into kind of categories, and they call them basically capital access points, or in the textbook, it abbreviates it as CAPS. And each cap basically has an example. And because again, like in the last slide, and like we've learned, it's really hard to, again, evaluate a company, a private entity, because again, it is on a case-by-case basis, and just as we discussed, it can change even when time elapses, right? Because again, there might be new risks that appear that an investor might need to take into consideration that could change the valuation of the business, and then therefore how much required return it might need to see in order for it to make an investment into this private entity. So in order to help kind of just this study, or again, kind of give you a frame of reference or a benchmark of what are some of these expected returns or required rate of returns for these particular capital access points, they tried to, again, kind of group them together and then provide just, again, kind of a ballpark figure, so to speak. So they base it off loan amount, maturity, interest rate, and then, as the professor said, also a lot of other expense and costs go into it as well that sometimes isn't seen on the outside. You know, it could be anywhere from fees or, startup costs, or, inspection costs and things like that. So basically, when we take a look at this study, this is more of an expected all-in rate of return, which can be calculated. And you can kind of see on the graph there, which is called the Pepperdine Private Capital Market Line. Pretty long, but it's abbreviated as PPCML. You can, again, kind of take a look at, on the left-hand side, what is your from a bank's perspective, what are they looking for versus private equity or venture capital. You can see that the returns tend to get a little higher as you move further right on that graph. And again, you can kind of see the major capital access points there. And the thing about this study was that it's not like, again, with private entities where you can use things like CAPM or predictive models to try and establish like what is an investor's required rate of return. This has to be based off empirical data, because you can't basically take a look at these instances or these occurrences until they actually happened. Because again, it is all on a case-by-case basis, so it's always going to be different when it comes to another round of funding or raising money. Again, it's not like you can predict it. It's basically where you have to do it first and then be able to collect that data to plug back into the study.
Okay, so stay at this page for now. So the Pepperdine capital market line, it is not just one time that you're reading in a textbook. Later on in the weeks, you will get the latest copy of their report. They do this twice a year. When they initially conducted the report, this is the one that you're seeing is the second time that they conducted the report. That's in the textbook. Ever since that they have conducted the second time, now every year they do it twice a year with the, what is that what's that business? Is that Dun & Bradstreet? Yeah, Dun & Bradstreet now team up with Dun & Bradstreet. So the surveys now has been done every 6 months with Dun & Bradstreet, and these numbers are really, really, really current. That gives you the Main Street's activities. So I'm dying to see the second half of this quarter. You can imagine that these numbers go through the roof because of the pandemic, because there's not enough credit in the market. Now, one thing that I do want to point out that Eric had mentioned here, that the CAPM, the capital assets pricing model, does anyone know the formula of it? Maybe we can decompose the formula to let you understand why this is irrelevant at this point when you were talking about private capital. Anybody still remember, especially those that are still taking the CFP exam?
Is that somewhat like the risk-free rate?
Yep. So there you got your risk-free rate, right? Plus your beta times your average market return minus the risk-free rate, right? So that's your typical CAPM. So the number one difficulty here comes in, all right, beta is not as easy to calculate in a privately held business. You can still calculate that. But who in the world, as a privately held business owners, are going to continuously evaluate their business value on a regular basis? That's just insane. On average, regardless about the size of the company, private company, on average, the cheapest one you're going to get is $7,600 per year. One report. That's the cheapest one. Typically, if it's a local firm that specializes in your industry, that takes up to about $22,000. So no one in the private world is going to do annual valuation like that. Some of the bigger fee-only or fee-based RIA out there, they're required by law that they have to do it every other year. But you can imagine that just to do that, the beta is hard to determine, not to mention about all of these returns that are on the chart from this point to this point. That kind of return, I mean, that's almost impossible. That's almost impossible to have the accurate CAPM to figure it out. That's the reason we're saying that CAPM becomes quite irrelevant in this case. Now, the other thing I wanted to point out that, yes, it's somewhat familiar to all of you here, that you understand what is a private equity group. You also understand what the venture capitalist or some of those hedge fund company who does nothing but these two kind of things. That's great. But one of the things that you may or may not be most familiar with is the factoring. And as a matter of fact, factoring happens a lot more often than you can imagine. Because when the business owners has nowhere to turn, they turn to factoring. Does anyone know what factoring is? There's going to be some definition later on in the textbook, but I just wanted to make sure that everyone understands the terminologies.
I'm familiar. Factoring is when a company buys the account receivables.
That's right.
At a very discounted price, and then they receive the entire amount once it's paid.
That's right. So you can imagine that right here, it is about 40-some%. And they tell you right off the bat that that's the amount that they are looking for. So let's say if you have $1,000 accounts receivable, right? Effectively, if they are going to require 40%, the owner are only going to get about $600 back. It is a very, very difficult proposition for private business owners to do that. But when they're in desperate mode, I'm not talking about borrowing money. This is just in a desperate mode, use it as, there's even what they call the hybrid line of credit factoring, which is the cheapest form of factorings. That's about 20%. Even with that, $1,000 accounts receivable, owner only getting $800. This is in a desperate time. Why would business owner do that? They're not selling their business. They are just wanted to make sure that they have that line of credit or some sort of money so they can do business continuously. Because a lot of privately held businesses, they do business with big guys, the Fortune 500 companies. And on average, how many days does a Fortune 500 companies pay the small guys? Does anybody know?
3 years, 6 months.
Yeah, about 6 months. So how are you supposed to do business? Several years ago, I have a client who was one of the major supplier for Procter & Gamble, right? And during the 2008 financial crisis, they have done business with Wells Fargo since the inception of the company. So they were in the business of about 25 years or so. In 2008, Wells Fargo was obviously, like any other bank out there, was in hot waters. So they pull every single line of, not every, but most of the line of credits back. And it led to a lot of small business unable to fulfill their orders. So my clients, just like anybody else out there, was so desperate. They went to GE Capital. Now, GE Capital is no longer GE Capital, but there's some other names out there. At the time, it was called GE Capital. GE Capital then offered the hybrid line of credit factoring to my clients with 20%, meaning that they take the 20% of the accounts receivable back. But here's a caveat. Because you're in the desperate mode that you are only using that money temporarily just to just to continue to do business with your client, the GE Capital at the time asked, my client only asked for $2 million line of credit. That's not a whole lot. They do business with Procter & Gamble. They do a lot more business than that, but they only asked for two. They have plenty of cash laying around, but they just need two to go get by the situation. The GE Capital at the time told them, that's great. We want to have $2 to $4 million somewhere, cash position somewhere in their associated bank. This is like a big joke. It's like, okay, I need $2 million, but you want me to deposit $2 to $4 million cash in your bank? It is ridiculous. So keep in mind, as you work with clients, they may not be in the exit mode, but you certainly will hear them talking about that. Something that I don't recommend anybody do, but if they have to keep their business going, they may have to do the impossibles. All right, thank you.
Sounds to me like a payday loan.
Worse than that.
Worse?
It's worse than that. Payday loan, at least they probably beat you up in the corner and get done with. The GE Capitals, they don't get away. Your business is pretty much in lien for the most of the time. So my client actually didn't move forward because I refused to agree with my clients. I told my client, no, just walk away. And so they did not. But you can imagine that with businesses that they don't have an advisor looking out for them, they could be in this kind of situation. And some private businesses probably are up in the debt in the yin yang that they didn't even understand. Okay, so thank you, Eric.
Perfect. Ari, could you actually go to the next slide? Perfect. So actually, this is just good transition after good transition, but just like Professor Chen said, I'll start with actually the bottom point then here is that the financial goal of every company, private or public, I think it's just pretty logical. You want to minimize your effective borrowing or your investment costs. So again, when we take a look back at the PPCML, it's basically how do I try to stay on the left-hand side of the graph as much as possible? And it's basically you only have to, you can create hybrid methods where you're raising, financing using various methods, but you ideally want to only move towards more expensive methods if it's absolutely necessary, if you're desperate and you have no other options. But here are just some other things I think, because like we will see the PPCML later on in the textbook and in this class, just to again kind of get some understanding about some assumptions about the line. It's just basically it's stated on a pre-tax basis. So capital providers typically offer deals on a pre-tax basis. A reason for that too is it's hard for the PPCML to assume a tax rate for the investee, just because there's so many different capital types that some will generate deductible interest, some won't. So how do you know like which assumption to use in that case? And there's also, again, there's different ways that these individuals and private companies can also manage their tax bill. So it is pretty much impossible to estimate a generalized appropriate tax rate for the private markets. So again, that's why it's on a pre-tax basis. But what it does do essentially at the end of the day, even though it is a case-by-case individualized basis, the PPCML, and again, updated versions probably will be much more relevant and a lot more accurate and helpful for businesses these days, but it is helpful for companies to at least get a frame of reference, like I said, a ballpark figure, if they're looking to form or add more to their capital structure. Basically just look at the line, look at the graph, say like, hey, like how much, would a investor be looking for a return, in terms of return, in order for me to raise, X number of dollars of capital for my business. And if, I don't know if we want to stop, but otherwise I'm going to turn it over.
You can keep going.
All right, perfect. So I'll turn it over to Jeff to discuss the business transfer.
All right, awesome. Thanks, Eric. Next up here. So now we're talking about how does an owner transfer either the entire business or potentially partial business transaction, right? That was quite fascinating, as I think this helps organize thoughts and kind of the thought process for, and really two different routes, right? Ourselves as we are financial planning business owners, but then also for clients and helping be a sounding board for them. So what we'll see is it first starts off, and I'll use the slide on the right-hand side there quite a bit, is it starts with the motives. So really, what are the motives and goals that the business owner has in wanting to make a transfer, right? The author describes 7 different key directions. It goes from more internal type transactions on the left-hand side to external on the right. The transfer methods then follow that, and those are really what I would kind of consider almost more the legal mechanism, the different steps. Some of them you might be familiar with, and we'll kind of talk about some more of the couple examples and kind of some pros and cons. But those transfer methods, again, the mechanism, and much like the transfer world a minute ago, that is what really drives the value, right? Quick example would be an internal transfer to a child, say, an adult child, for let's say financial planning business, would be very different than bringing on partners or maybe combining with another firm. You're going to have a very different value approach and very different reasons for wanting to do that, right? The other big thing is the owner can not only try to foresee what the value of the business will be based on the different type of transfer method, but then also is able to look at what timing would be best or most fitting for them. So in the next page here, I'll go through a couple of different, kind of try to distill out a couple of different rough examples of maybe some of the different scenarios that we're familiar with. So we go to the next slide there, Ari.
Can I just ask something real quick? Go back to that previous slide. So for the most part, I think in the financial planning round, this is what you heard a lot, right? But you can see that there are so many of them out there, but none of us have been properly trained. Hence, for this class to help you, that owners there are different ways to get out. Some don't want to get out, so you need to get yourself familiar with understanding and listening to what the owner's goals and objectives are. Sometimes it's not a clear cut as let's just do a external transfer, or let's just do an internal. Sometimes it's a combinations of all of these methods above. So it's not just a clear cut of one channel addressed at all. So keep in mind that it can be as complex and it can be as simple, but none of that is going to take very, very short time to do. All of these require time. So there's one thing that you need to enable to transfer properly is to require time. Okay, thank you.
All right, super. So again, back to the chart a second ago, right? There's internal versus external is going to be a huge driver of the valuation, and again, part of the motives for the transaction. I thought it'd be helpful to think about a couple of different examples, not necessarily only for financial planning, but maybe some of the different types that we're more familiar with, right? Kind of like I already mentioned earlier, an ESOP, from our CFP type of studying, right? ESOP, family limited partnership, negotiated sale, or of course, ever popular IPO. And as any of the different mechanisms there earlier, there's going to be very different pros and cons that are going to be helpful to talk about and think through with the business owner. It's going to come down to a lot of different things, right? How much information are they willing to share, right? What is the price, and how much of that is a driver that's trying to go absolutely for the highest price only, which might lean more towards the external type of route, or are they really thinking more of the family, internal employees type of route, right? Limited partnership or ESOP. How much involvement does the business owner want in their own? How much do they want in terms of involvement from others? Are they wanting to take on partners? How much complexity are they wanting to deal with? So overall, it's going to be, much like the professor shared there, quite a conversation, or a number of conversations to have. And the author points out that, this is how you help the business owner conceive the roadmap. And then it's going to be enlisting the respective experts based on that roadmap and those directions, get the right experts to help then move along and facilitate that transfer. That's transferring. So I think it's Jordan up next.
Perfect. Thanks, Jeff. So yeah, transitioning to my sections here, the owner motive section. This is a little bit more of a qualitative section in comparison to the ones we've had so far. But starting with this quote from the text, I liked here in the top right. It says, "A motive is a goal that initiates an action. The governing authority must sanction an owner's motive for a goal to be met." So I personally really like this quote from the text because it sets the stage well for these next couple of sections. And it clarifies the differences between motives and goals, and also draws attention to the importance of the involvement of governing authorities when achieving a goal. So moving on down here, it says that the motives of private business owners initiate an action. Motives are not like dreams, in that dreams do not lead to action. So the text went on to explain that no positive outcome is possible without the additional support of the appropriate authorities. And like it says here, there's kind of a couple different sections for those of us who may already work with business owner clients, or it's just basic common sense, right? They've every business owner who starts a dream, or a business, I'm sorry, obviously has dreams. Motives will lead to action that will ultimately accomplish, hopefully, those dreams. An example here is, many private business owners dream of going public, but the text specified or pointed out here that 99% of those never become public entities, because the authorities in the market must support the motive and provide it with additional momentum. So one example of that, or one instance in this example is, a private business owner would need to convince a public investment banking firm, which is the authority to take the company public. So a business owner will, in order to accomplish their dreams and take action through their motives, they'll need support from the governing authorities for those motives. And so one thing I also found interesting from the text here is that unintended consequences can occur when private business owners act without considering the governing role of the authorities. So for example, kind of piggybacking off of Jeff's section there, if a private business owner acts impulsively and decides to give company ownership to employees through ESOPs or phantom stock, et cetera, those types of things, without regard for the governing rules that go along with the action, unintended consequences can occur. So this is one area where financial advisors such as ourselves can add great value by being prepared to assist private business owner clients with the available options and then accompanying consequences that come along, pros and cons that come along with each of those. So understanding their goals and motives is important, and then we can provide them with all the available options that are out there and the pros and cons to each. Continuing on here, private business owners need to understand the mutually exclusive features and functions of the private capital markets. Once their motive initiates an action, specific possibilities or doors are opened and closed. By proceeding with an initial motive without proper information, the owner could be unknowingly choosing a course of action that narrows future options. For example, access to future liquidity opportunities based on the type of compensation they elect to give to employees. So I kind of liked the analogy of opening a door and maybe closing another, right? So if they choose one path, if they open one door, that might close another, and sometimes it can be a one-way path. And so on top of running their business and everything else they have to worry about, it's important for them to understand the consequences of the actions that they take. And that's where, again, we can provide really great value in this area.
So think about your owner clients are basically in a maze, right? Yes. The door opens and they might got through, but then they might go to a dead end. And that's the problem that a lot of owners face. And I like the fact that you mentioned about the giving employees stocks. And I have a habit telling my clients, no, don't do that. Not that it's not a good thing. It's just that exactly what you say here. Sometimes they do not understand the consequences. That one stock that you give, or that partial stock that you give that employee could stop your entire transaction when you need it the most. So there's a lot of consequences that as Jordan mentioned, that we need to be in a better position of helping our clients understand that. Okay, thank you.
Perfect. Thanks, Dr. Chen. So Ari, I don't know if you want to go to the next slide. And I'll try to go fairly, I know we're short on time, I'll try to go fairly quickly through this authority section, but this is just piggybacking off of the last section. We specified that, for every motive, a business owner would need the support from the governing authority to accomplish the motive or the goal. And so the authority refers to agents or agencies with primary responsibility to develop, adopt, promulgate, and administer standards of practice within the private capital markets. As it says here, once an owner sets a goal, the relevant authorities must be heeded. Authorities set the rules and processes regarding business valuation, capital structure formation, and business interest transfers. I liked one point here. It says authorities in the private capital markets provide these rules and act as traffic cops to ensure compliance. So I just like that analogy, for those, those as advisors. I think that'd be a good analogy possibly to use with clients, just to help them understand, point out that they act like traffic cops, that they're there to enforce the rules and regulations to ensure compliance and fair treatment for everyone. And so that's kind of the analogy for authorities. And then some examples of authorities can include, for example, in the world of fair market value, the IRS and tax courts are the primary authorities there. And then in the world of capital, banks and venture capitalists are the primary authorities in that world. And then the fact that, authorities have varying degrees of sanctioning power. So if we want to go to the next slide, I'll try to go through this quickly. This is just a kind of an exhibit here, a table from the text. Just a couple points to make. There's the 3 columns, right? So each governing authority, the first column talks about government action. So the authorities derive their legitimacy through government action. That's what regulates their valuation process and gives them the authority to act. And it says here, government-based authorities ultimately are limited by the consent of the governed, which I thought was interesting, right? So these authorities act, they're given authority by the government, but then they are limited by the consent of those that they govern. The middle column here, compelling logic, talks about, how the authority grounds the language and logic in the community that it serves. One example of this that the text gave was the authority that fights to win the logic battle. For example, the ERISA laws and the various ESOP service providers. So that's kind of what governs that area. And then I thought, again, this is one area that we can provide great value is there are so many governing bodies out there, is just helping our business owner clients to understand the available options and the governing authorities that they're going to need to navigate in order to accomplish their goals. And then lastly, utility, which as we know is an economic term. So the governing authorities derive their legitimacy from the utility of their logic and actions. And the utility is measured by how well that they actually help their members accomplish their objectives. So they're not necessarily there to just prevent, anyone from accomplishing anything. But rather it says here that, their utility or their usefulness is measured by how well they can actually help members accomplish their objectives and do so in compliance with the rules that are out there. So that's it on this section that I had. I'll turn the time over to James for the last section we had.
Thanks, Jordan. So I'll be going over the concept of triangulation, which essentially kind of brings together everything that the rest of my team has discussed so far. And essentially describes the correlation between the transfer, the valuation, and the capitalization of a business, because each of these are dependent completely on the other two. Right? The value of a business is directly affected by the company's access to capital and the transfer methods that they're pursuing. The capitalization is dependent on the value world in which the company is viewed. I know Ari spoke about the different value worlds available, fair market value, triple value, investment value is some. And also dependent on the different transfer methods that the company is looking into, right? And then the ability of a company to transfer its ownership is conditioned by its access to capital and the value world in which that transfer might take place, right? So there's a lot of different valuations that a company could do, and the result of those is going to be kind of dependent upon what type of capital they're bringing in, what type of transfer the company is planning on. If the valuation for a stock transfer to employees, it might be a lot different than the valuation for a business owner who wants to sell his company to outside investors, right? Especially if they're going to be stepping away from the company. So there's a direct correlation between all of these things, and all of them are dependent on the motives of the owner, right? Whatever the owner's end goal is, whether that's to sell the company and step away, or to motivate the employees by issuing stock in the company. All of those things are going to affect each other very much.
All right, so
Next slide.
before we go to the next slide, I just wanted to make one thing across that when you're looking at a triangle, right? So we have capital, we have transfer and valuation. Keep in mind that the triangle can skew. When this is not available or limited availability out there, this could potentially go down. The chance of doing this successful will also go down. Keep in mind, the triangle can skew in any given point. Therefore, it is not always a perfect shape. And so giving today's environment as an example, right? As the pandemic we're still somehow in the valley. We haven't rise up yet. If someone were to sell their business today, this will skew really terribly for that particular owner. And it's not because of that business, it's just because the market condition. So there are still things that outside of the owner's motive will still impact this triangle. So make sure you keep that in mind.
Yep, and that's it for our group.
Okay.
Not sure if
Great
I'm supposed
job.
to open it up to questions or just three questions.
Why don't we move on to the next group? I guess I talked too much. So why don't we move to the next group, and then if we have time left, then we'll come back to the questions. Great job, guys.
Okay.
All right, so next group, whoever wants to take control of the screen, just go ahead and share the screen with your slides.
Yeah, Jeff Seaver, I think you've got the beginning portion, right? Do you want to take it over, or do you want somebody else to do that and just stream slides for you?
That would be great. I don't have it downloaded on this computer. I can grab it, but it might take me a couple minutes. Bear with me here.
Oh, hi.
Yeah, we got a little visitor here. Too early to learn about some fun.
Oh, so smart. He's
He's
already attending the graduate level class.
Yeah. He teaches me everything he knows. It's great.
Jeff, I got it pulled up if you don't want to download it. This is Chris.
If you do, that would be great. I apologize.
Yeah, Chris, if you have them, just go ahead and take control of the screen. Thank you.
You want to go put it in the trash tube? Huh? All right, so our group presentation, as you can see, we have Chris, Logan, myself, Jeffrey, David, and Jade. And I'll start off by going over a little introduction about corporate executives, high-level overview of them before we break it down into some more of the 5 pillars. So go to the next slide.
All right, I hear you. It's not, we've got 3 screens up here, so I'm trying to make sure I'm on the right one. I apologize.
Yeah, you may have to share the right screen otherwise.
Yeah, Chris, you might need to switch it to a slideshow inside PowerPoint.
Okay, great. There we go. Thank you.
There we go. So corporate, there we go. Perfect. So corporate executives. So who exactly are they? Generally, we're talking about people in a position of leadership or management within a company or corporation. So think officers, presidents, vice presidents, really could be any sort of titles like that. But they're going to be high up in the company. They're going to be higher paid And a lot of that reason is because they are high up and helping to direct the company towards its goals, or even helping to influence the vision of that company. So they have sustainably or substantially progressed along their career path and now find themselves in that position. They're going to have a lot of skills, leadership and management skills, obviously, for their position. A lot of this is going to come from their deep education, a lot of training, a lot of business and life experiences. They've gone through various roles within a company or within other corporations, and learned a lot on the way. Generally, with all of this knowledge and with this focus and these high aspirations they have, they tend to set very high goals and worry about achieving them, just as they would for their business. They do that personally as well. And next slide. So when they are thinking about their finances, their life outside of the company, this is a little bit about what they care about. And it shows that they do have greater levels of concerns than other millionaires. They worry about everything about across the board a little bit more than you might other see from people in their either income bracket or in their net worth. So some of these highlights are managing investments, supporting their lifestyle, especially trying to support their current lifestyle, increasing their wealth, planning for taxes, planning for their estate, inheritance, things along those lines. They do have a lot of needs, and they spend a lot of time thinking about them. Next slide. So with all of that in mind, why do we care about them? You know, specifically looking through the lens as financial planners. Biggest reason, they're highly compensated. They've got a lot of money generally, or if they don't have a lot of money, their income's pretty high. They potentially have a lot of assets coming their way. So if you're looking to expand your business, you're looking to increase assets under management, certainly having a couple of these corporate executives can help you towards that goal. With that, we also see that fewer than 25% do assign their finances or have others do the managing of their money. Although even with that, 69% of them do work with an advisor in some way. And this tends to lead itself back to what we talked about earlier, their knowledge, they're driven, they're very concerned about these things. So a lot of them do want to have a hand in their finances, but they also do recognize the value of working with an advisor. Because they can have very complex finances. Some of these complexities that they might see that you might not see for other individuals is they're going to be employed under a formal contract. It's going to spell out a lot of details as far as their compensation and other items that they need to be aware of and they need to be able to plan for. Certainly, as we saw with the case study, there's a lot that goes into it, and thinking that you don't really have to pay attention to it doesn't always work out the best. So the compensation that they have generally is tied to performance goals and standards. Their salary doesn't necessarily make up a great deal of their compensation. A lot of it's going to be variable. Some of that is going to be tied to equity-based rights that they might have or might be issued within that company. This is going to, tie them and their interests to the company and hopefully move it in the right direction, and correlates their fortune to the company's overall performance. But certainly that can lead them to be very concentrated in their investments when it so much is tied to just their employer. They're also going to have extensive and intricate benefits and potential legal risks to consider. So all of this can really lead to a lot of planning, highly personalized investments, tax planning, estate planning, liquidity considerations. So if you are able to offer a one-stop shop or be able to offer these services for a client, you can really provide a lot of value for them. And I will turn it over to talk about the 5 pillars.
Dave, we got you on mute. Can you unmute yourself?
I thought this was lip reading 101. Sorry. Okay, thank you. So I'm going to be talking about the first pillar of the total 5 pillars, maximizing the rewards of working as an executive. The next slide, please, Chris. Chris, thank you. You know, as we've gone through these different ups and downs within the market, we hear about these different golden parachutes of, you know, I saw Angelo, the gentleman from Countrywide here in Santa Barbara, and he's kind of one of the more notorious ones, golden parachutes that get tons of money and their company gets kind of driven down to the ground. And a lot of that comes through the company executives agreements that they signed as they were launching into the role. You know, the executives are the very position, they are employees of the company. So they have the basic type of things that the typical W-2 employee will see. You know, you have your employee manuals and benefit plan descriptions, and all those are fairly standard and boilerplate. But it's the employment agreement that the executives really have to pay attention to that really allows them to control the outcome of their income, not only while they're employed, but should something happen to the company or should they decide to leave, this employment agreement really kind of fine tunes what's going to happen, and not paying attention to the details of these agreements could be very detrimental, as we saw to David with Goliath. He stuck with them, and then the company got sold from a bad acquisition deal, and he ended up with 18 weeks of salary, which was about half of his compensation, because he didn't want to pursue at looking at the employment agreement in detail, afraid that he was going to offend someone. And so some of the things that are highlighted in the employment agreement, you know, base incentive compensation, equity-based incentives, executive benefits, severance, restrictive covenants, and changes of control really are some of the main things that you'll see in there. And, you know, I have a client that's a past CEO of one of the large credit companies. And, you know, he's got this amazing defined benefit plan, paying him a ton of money for the next 5 years, and he hasn't worked. His biggest problem is taxes. And so he definitely went through the agreement, looked through it, consulted with an attorney, and set it up right for himself.
So before you go to the next page, great examples there. One thing that I have always concerned about with financial planning is when we look at cash flow, or when we look at a budget of a family, when your clients are in executive roles, in this case, right, if they are involved with any of these terms, your typical emergency fund go through the roof because they don't fit. They don't fit in your typical 3 to 6 months. It doesn't work. That's why they have the severance package in place where typical agreement is anywhere between 12 to 18 months. That's a typical average term. And they may walk away with 2 years severance. But the problem is that part of the CEO story that you mentioned for the 5 years he hasn't worked, that's great. But that's also because he or she could potentially take much longer to land the next job or the next contract. Therefore, when you're doing planning for executives, your typical 3 to 6 months, it just doesn't work. You really have to, if you could get a copy of their employment agreement, read through it, and then plan accordingly on top of the tax situation, because these are all in the fine print detail. And if you're not paying too much attention of it, your plan will not help your executive clients. Okay, thank you.
Thanks, Dr. Chen. So yeah, so really, it's really focused around the employment agreement, and you know, planning around it. The client really needs to negotiate the terms, involve the proper attorneys that making sure they're going through this, and that is not only fair to the company, but also definitely fair and more giving to the employee. So that way, if the person needs to leave, or if someone is going to another company or the company fails, there's a lot of restrictive covenants that are put into place. I know I've seen some of these, not that I was an executive of a large firm, but just buried in the employee handbook, right? Non-compete, non-solicitation, confidentiality, non-disparagement agreements are all things that I've seen. And I know executives are held to them. They don't want you to be paid these big salaries and have these great promotions just to go somewhere else to take all the clients with you.
Mm-hmm. That's true. And then this non-compete here could be a big killer because they could stay 12 to 24 months. So hence, your severance package has to align with these, because that means that they cannot find something, even if they want to, they cannot. So you have to really, really watch out for your executive clients, their benefits. We really have to watch out for that. Thank you.
Yeah, thank you, Dr. Chen. And with that, I'll hand it over to Chris.
I was taking lip reading class too, sorry. So thanks, Dave. We're talking about achieving financial independence. We discovered that these executives aren't necessarily interested in retiring early. The book uses the example at age 60. They define it as financial independence, the state at which they can afford to retire or pursue other passions in life, at which the maximization of employment-related income is no longer really what matters as much. They're not necessarily interested in retirement itself, but more interested in having the option to retire. So
before you go on to the next page, this is a question for everyone. For those executives that you work with, what is the average age they retire? I like the option to retire, because they all have option to retire. Do you know what their average, based on your own client base?
beyond 70 for me.
Beyond 70s, anybody else?
This is Jeff Reagan. I would say the opposite. I think a lot of them want like age 55 or so because
That's right.
they're really worried about being aged out.
Well, most of my executive clients are 50. So the problem is not money. The problem is that they need to know what they want to do. That becomes a big issue. So oftentimes they will then sit on boards. They may not take a full-time job, but they will sit on boards. And so guiding them through is not as, money is important for them, but guiding them through that from a soft side of the approach is far more important than the investment, than the money side of the things. Okay, thank you.
Yeah, so they're not really retired at 50. They're just financially independent at 50.
That's correct.
So my point is that they're still working beyond 70. They're just not.
They could, but they just have option, right?
Exactly. Okay, so when we're looking at this, all these variables come at them with life expectancy, projected taxes, goals, needs of dependents, whether that's their parents, whether that's their children. A lot of my clients are in the sandwich generation, if you will, right now, taking care of their client, or excuse me, taking care of their parents and their kids, not to mention themselves. I'm sure you've all heard it. They'll start saving for retirement once their kids are through college. Inflation, macroeconomic conditions, and then projected incomes and expenses. All these come together and play a huge role as to when they can retire, if they're truly able to walk away at age 50, or if they got to stick it out another 5 years, 10 years, 15 years. Maybe they were planning on walking out of the office in June of this year. And because of what's happening right now, they're not able to do that, or they're rethinking that. So when you're dealing as a financial planner with these folks, this is a little triangle that I've had with me. It's kind of ironic that the slide is a triangle. I didn't have that in mind when I gave you guys the slide, but that's exactly how I use it. It's risk management on the bottom, wealth accumulation in the middle, wealth preservation and distribution. For those of you that are familiar with Northwestern Mutual, this is what I used the very first 2 years with that company. And all we did was risk management, because you were drinking Kool-Aid selling life insurance. But the reality is, once you get the CFP, you focus on that wealth accumulation and the most tax efficient way to help your clients out with that. Now that your foundation of risk management's in place, it's a lot easier to do that. And then once they get to that final third tier, wealth preservation and distribution, any of the variables that you see on the left slide there cannot affect the foundation, the pyramid that you've built here, because you've done an efficient job at helping your client address all of those issues before they even become an issue. That's my slides. I'm going to turn that over.
Chris, that triangles stuff that you have there tells you that how much subconscious that our stuff ingrained with us without even noticing.
Right.
This is all that financial behavior things comes in. Thank you.
Okay, thank you, Chris. Now let me present for the taxes issue, the pillar 3. Minimizing taxes is very important for executives because the rewards of the executives will be reduced if there is no proper tax planning. Furthermore, the taxes and cash flow have an opposite relationship. The more taxes, the less cash flow. Next page, please. Generally, there are 8 main strategies to help the executive to minimize their taxes, including differing income, maximizing deductions, planning for taxes withholding, understanding the difference of the ordinary income and the capital gain, being aware to the equity-based grants, understanding the tax aspects of the retirement planning, maximizing the use of specialized tax provisions, and the application of different types of income taxes. When applying these strategies, we need to consider the current situation of the executives. For example, is the executive employer or employee? As an employer, the executive may focus much on the maximizing tax deduction other than providing benefit to his employees when choosing the proper retirement plan. In the case of our textbook, Arby was a business owner, and she had 14 employees. If Arby decided to choose SEP IRA or simple IRA as a retirement plan of her business, she might run a calculation to determine which one is more deductible for her business from the business side. Yes, another example is for a self-employment business owner. Establishing a S corporation is a good way for a self-employed business owner to avoid employment tax, because the income except the salary for S corporation except a salary for X corporation is treated as dividends and is not subject employment tax. So it's a very effective to the planning strategy. So from the above, we can plan carefully for the executive to help them achieve their minimizing taxes goal. Now let our team member.
Yeah, so let me just touch on something real quick, and we'll talk about this later on in the terms. So the most popular form of corporation the CPA will recommend is S corporation because of the employment tax, yada yada yada. That's great, but that's something that you also need to let the business owner know, that in terms of when they exit, the best form is not S corporation either. So once we're gonna talk about the section 1202 later on, then section 1202 require you to be in a C corporation since inception. So lots of different things that you take into consideration. Is not just one answer is good for that particular business owners. You need to be in a position to help business owners to analyze which type of entity is best for them in terms of starting up, as well as when they exit, that capital gains, how to manage those capital gains plays a big difference in terms of cash later on in their life of the business. Okay, thank you.
All right, so I'll discuss pillar 4 here. So this is planning for others. One of the interesting things with this is that, of course, what Jay just talked about was, helping executives and business owners with taxes. And most of them are aware of that. They know they pay a whole lot of taxes. And of course, in the category of taxes, you've got estate taxes, gift taxes, generation skipping taxes. And I mean, I certainly found very often in my career, this really isn't anecdotal, that the number of business owners and executives really kind of stopped there. I mean, the number of times I've talked to people who were wealthy who would say, well, my estate's only worth about $10 million, so I don't need any estate planning. I'm not going to have any estate taxes. All right. It was kind of baffling to me the way they would truly see it as, I'm doing it for estate taxes. Or when they say something to you, well, I have a revocable trust, so I don't pay any taxes. What's the matter with you? Of course you're paying taxes on that. So they kind of end sort of the process of what they really need to do to protect themselves and others, kind of when it ends from the tax perspective. All right, so here, of course, the next dot here talks about considers planning for the ongoing future and well-being of family members, non-family dependents, charities, and I also added in other people or organizations important to the executive. So it's really looking beyond and really thinking very much more about a legacy and making sure that your assets are doing what you hope they do, and most importantly, of course, not cause any fractures in your family with people fighting over things. So of course here it says many executives overlook estate planning that goes beyond potential tax consequences. And certainly, it's ensuring that the executive's affairs are also managed properly in the event of incapacity. It's not just a trigger an event like death, which of course could have an impact if they're a business owner. Where does the company go? Who's going to take over? Are there partners? But also just what if you can't manage your own affairs? Because it certainly is more and more common these days that we as Americans become incapacitated because we're living longer. And that's a very important aspect of that. So go ahead and go to the next slide.
And sometimes I tell clients that, great, the problem is we don't die.
Yeah, I know the problem. Well, what's funny with that too is that women, of course, are much more likely to become incapacitated,
right.
Where men are just much more likely to die.
Yeah, but then, when you die, you get rich from insurance. Yeah. That's great. But the problem is you don't die.
Yes, I guess it depends on what you prefer. I mean, I guess to a large extent, I'd rather just kick over and, kick the bucket than drag on and on and on. But we don't always have that choice.
Right.
So, go ahead and go to the next slide there, Chris, if you can. So these are just some of the components of that when looking at the pillar of planning for others. So you can see some of it is pretty simple. Those of you who've been in the business for any level of time at in any role probably understands that there's some basic forms. You've got a will, you do a durable power of attorney, healthcare proxies, some of those simple things. But a lot of times people end it at a will. They're really planning for death, not really for incapacitation. So some of this can be really simple. In fact, in the earlier presentation when they were looking at doing some transfers of a business to family members, they talked about some of these that can get incredibly complex when you're looking at different types of irrevocable trust. Can be extremely complex and can get very expensive, but it's always something that, and the important thing with this too is also to understand that it kind of builds upon itself. I mean, putting together the basic estate plan where you're working with somebody who is young and affluent, you put a will and healthcare proxy and living will together for them. Then later on, they could add to that the revocable trust. And then when they become very wealthy, maybe they built a business, that's really where you could then add on top of that another layer where you're looking at some of these different types of irrevocable trusts. And certainly with charitable trusts, on the tax side, I have had multiple clients in my career who have set up charitable trusts, charitable remainder trusts, when they really didn't care at all about the charity. The charity really didn't mean anything to them. They were purely doing it for the tax benefits of what they would receive by doing that, by avoiding capital gains taxes. And in a state like California, where capital gains taxes, you've got 20% federal on the high end and 13.3% state and a 3.8% Medicare surcharge, those charitable trusts get very, very desirable, even though I've worked with clients to say, I don't care who gets the money to save me taxes now. So, all right, we'd go ahead and send it over to Logan then.
Great job, Jeff. I mean, I think everyone kind of touched on these points involved in risk, so I'm not going to beat a dead horse here, but we see a risk managed a lot of times with insurance, the basic life insurance, disability, liability, P&C. But just like Professor Chen mentioned, this is something that you pay for your whole life. Sometimes it's limited pay, and you hope you don't have to use it, but sometimes it comes in handy, especially for beneficiaries. But like Jeff mentioned, a lot of executives don't take advantage of these types of products because they're not thinking about that. The other part, I think, diversifying your assets. A lot of executives like to lean heavily on their company stock, which it's great when your stock's performing really well, but why be over concentrated in a position if no one's forcing you to do that? So I think that's really important. And finding the right asset allocation. I can't tell you how many times I've seen directors or other high executives come into our office with a way too aggressive allocation approaching retirement, but they're like, oh, it's performed well. And hopefully they shift out in time, at least something that's more moderate, because I mean, obviously you don't go to cash and things like that, but they've been on the lucky side of things and they think that's going to work out for them in the future. I put capturing different prices in the market by consistent investing because there's people that really try to time the market. I know that's really a more investment philosophy thing, but I think continuously investing, especially when you're young, into Roths, retirement accounts, I think that pays off for many people down the road. And some people view it as too risky over time, but as long as you have different buckets of investments in cash, I think that's a good thing to do. And then I put cash on hand. We talked about the emergency fund and how with executives, you can kind of throw out that 3 to 6 month rule. I mean, there's executives that, like I said, lean on their stock for this purpose. Oh, I'll just sell stock when my window opens and I'll use that. And then the price goes down and now you're, oh, I have to sell more shares than I thought I was going to have to. So I think keeping enough cash on hand is very important. Chris, can you go to the next slide? Succession plan. So we were talking about business owners and whether they want to think about succession or not. I think it's important to just bring it up as the financial planner because they're not going to think about it until they're forced. And by that time, it might be too late to do something that's desirable. So I think it's important to do that, not only for the business owner itself, but just like Jeff was talking about, this is kind of a trickle down effect in that the business owner might die and then your family might be SOL, and not get the benefits that they really should have gotten because of the lack of planning. So the risk doesn't stop with the executive. It really impacts the spouse. I think too, when a spouse is working, it's important to take advantage of the benefits that they have at work too. If you're lucky enough to have a dual income family, such as like spousal IRAs and things like that, other health benefits, HSA contributions, things like that. And then I think with business planning, like I mentioned, it's never too early to think about it. It's uncomfortable. No one wants to think about giving up something that they've worked so hard to build or dying prematurely, but it's our job to kind of play devil's advocate and bring it up. I've seen business owners that weren't thinking about it and then an advisor brings it up, and once they start hearing about the numbers and how their business is valued and these high numbers, it kind of excites them about this option, at least having the option to sell their business or transition out of it over time. So I think presenting the business valuation side of things is important, and we have to be able to do that. And then I put down there at the bottom, doing nothing to manage risk is the only wrong answer. I think, yeah, that's absolutely correct. You can't just sit around and wait for something to happen. You have to be proactive, whether that's on the investment side, the estate planning side with beneficiary designations. Jeff talked about people just worrying about simple wills. It happens so often when people bring in their statements and they don't have any beneficiary designations, but their account is a couple $1,000,000. I don't see how that was never brought up, but that's our job to bring that up to these executives so that their assets can transfer efficiently and in a manner that they want to. I don't think we have anybody after me. I think I'm the last slide.
Okay, great job. Great job. Thank you. Let me, I don't think we'll have time to go through any questions at all, but I do wanted to share, and if you could bear with me, I know it's already 7 o'clock, but I do wanted to share a couple of things. These are just statistics. So one thing I do wanted to share quickly is that there is a concept that when you work with the business owners, that this concept needs to introduce early on, and that is that business owner really, there are 3 different categories. Are they just having a what I call the they are the technician, right? Or they are the manager or the architect. In general, how we measure that, because there's not a way to measure who is what. So in general, if the business itself, so the entity, can pay the owner of a salary roughly total compensation. So this is a total comp, including all the perks like a car, insurance, and so on and so forth, roughly about $100,000. Okay, then this owners effectively create a business of a job, of a technician, and if the owner itself, and this category has a lot of people in there. So for those of you who work with the business owners clients, you can actually see if they are in that category. And then the manager is that the entity has the ability to give the business owner a total comp up to about $250,000 or so. Okay, that's in the manager category. You don't necessarily start creating what we call the entity equity value until someone gets in here, and that's roughly somewhere like a 300 or so as a total comp. Additionally, that they are able to use their business equity, whatever that their baseline is, they can create 3 to 5 times of that equity value. So if you look into your business owner client base, you can quickly see that who is in what zone, and each one of those will require different type of planning. For example, someone in this zone, as a technician zone, they don't need to go that complex. They don't have to, because chances are they cannot sell their business. So stop wasting your time. So this is something that you wanted to be able to manage your clients accordingly. In addition to that, some of them has the potential to move up this way and move up to this way. You need to recognize where they could go to and give them necessary help to get there. Not most likely, this is just based on my experience. This is not a simple formula. Chances are it takes approximately 10 to 20 years just move from this point to that point. Once they reach 20 years, if they're structured properly and really, really strategically operate that company, they could potentially go here. And that could happen between 20 to 25 years. And the transfer could occur within that 5 years period of time. So this is an important concept that at least I want you to walk away with looking at the presentations today, as well as working with clients. Each one of these clients are in a different bucket, and you have to treat them differently because their complexity is very, very different. And you don't want to you don't want to talk over them either, because sometimes they don't understand what you're talking about if they are in the technician level. And they may tell you that I don't need that. And they're probably right, they don't need that. So be careful of how you actually work with them in terms of communication. I wanted to make sure that I go to the last slide of the homework assignment. I'm sorry, I wasn't able to cover everything all at once. So next week you have your business model. When I say business model, that means that I want you to take a look at your own practice, what that business model looks like. Some of you may have other business going on. If you want to take advantage of doing that, do that. But I'm looking to have you fill out that business model of your own practice, if you will. You're going to begin doing the research paper first module of looking at the research questions. 2 of you have already sent email to me regarding about what topic you're looking for. Great. If you haven't done that, I'm looking forward to see that either through the email or through your first module of the paper. The bottom line is that you probably need to start doing some research in some peer review article to support your questions, okay? Whatever your topic is. In this paper, I'm looking for you to at least identify 5 to 10 articles. Articles could be in the Blackboard that I provided, or article you simply find in the library, okay? Make sure they are peer reviewed, or at least some sort of government type of research paper. So you need to identify at least 5 to 10 of them, because these articles are going to be used later on for you to do literature review. So minimum 5 to 10. When you actually write a paper, I need to have at least minimum 10 of your final paper. 10 is not going to bring you a lot of material to write. So just keep in mind, you need to spend some time, look at what you're going to write, and then associate that with appropriate number of articles to support that. And then you have your group 3 PowerPoint presentation. Group 3, let me go to Blackboard real quick. I think group 1 is going to do chapter 4 and chapter 6. Group 2 is going to do chapter 11. Okay, so again, SLE's textbook is not easy to read. So there's a lot of materials. Be sure to spend appropriate time to prepare for your group presentation. At the same time, do your business model work as well as your research questions. And in terms of the research questions, if I go back to group 2, you'll be able to have there's a list of documents for you to, list of questions for you to actually answer. Be sure to answer at least half of those questions to help you write the document. If you can answer all the questions, then you're in very, very good shape for that. All right, with that, I know that we've gone over 7 o'clock. Great job for everyone for the presentation today. I'm looking forward to your next week's presentation. Does anyone have any questions?
I do have a question about the first research module. So if we exceed 2 pages, because I've started writing it a little bit, looks like I might exceed 2 pages. Is that an issue, or does it have to be within?
That will be fine.
Okay.
It's just not going, if you don't have 2 pages, it's hard to answer all the questions. Yeah, so minimum 2 pages, yes.
Thanks.
Any other questions?
I have a quick question. This is Jeff
Okay,
Reagan again.
Mm-hmm.
You had mentioned at the very beginning of the class that the student questions that we had submitted.
Yeah, we didn't have time
sufficient.
to answer any of that.
No, but you said that they weren't sufficient, or they weren't quite.
So yeah, so let me go through the questions real quick. So like, for example, this here is, these are good questions. These are good questions. Okay, I think this is, I don't think this is related to the chapters that have been presented. So next week, I don't need a lot of questions, just 1 or 2 questions will be fine. But the key is that I'm expecting you to read. So let me go through week 3, bear with me. So let's say group 1. So Chris, you are in, Jeff, which group are you in?
Group 1.
You're in group 1. So that means that you're creating questions for group 2s, which is chapter 11, which you also read that chapter, but you come up with 1 or 2 questions the most, because as what you've seen today, we didn't have enough time, but just come up with 1 or 2 questions, that would be fine. So the opposite of the other group is same thing, that you will be, if you are preparing for chapter 11, then you're going to come up with 1 or 2 questions for chapter 4 and chapter 6. Does that make sense? Does that answer your questions?
I think so. So maybe brevity and simplicity is a lot more of what you're looking for the questions.
Right, right.
Okay.
Right.
Yep.
All right, any other questions? All right, with that, great job, guys. Keep up the good work, and I'm looking forward to reading your first module of your research paper. Be sure to stay within the business owner planning round, and be narrow as possible. If you go too broad, it will make your research much more difficult. Just find one or two research questions to support your research. All right, with that, and I will see you next week at 5:30 Monday. Have a great week. Thank you, guys.
Thank you.
Thank you, Dr.
Thank you.
Chen.
Mhm.
Good night.
Good night.
Good night.